Hello and welcome to this week's ITPM Flash. Ed Shek here, and today's Flash is entitled Get Shorty. So volatility is looking nicely set up for 2025, which means we should have an excellent trading environment for us all. Now, I know it's only Jan the 12th, but over the festive period, my email has received on an unsolicited basis about 8 amazing new trading systems. You know, the sort of thing. Amazing, quant-driven, back-tested, going to beat the market by 30%, or AI quantitative stock selector that's going to outperform and make you 400% in 6 months, and it'll even tell you the day the stock's going to start rallying. Well, I can't really comment on that, but what I can say here at ITPM, our process is exactly the same as it always has been. Just the core ITPM principles of professional level long-short portfolio management and risk-adjusted returns. And it will always work. And here at the ITPM, trading success is built on excellent risk management, fundamental stock picking, asymmetric returns, and being ready for all outcomes. And that will obviously mean no chasing, no FOMO, and no getting sucked into shorter and shorter time horizons. The process is always the process here at ITPM. And when you are trading the 1 to 3 month time horizon, which we do, reacting decisively and unemotionally when the data changes or consensus narrative changes is as, if not more important, than pretending you can predict the actual future. And what I really mean by that is, instead of guessing where tariffs are going to come in at, are they going to come in hot or cold, just have trades ready for both outcomes, all outcomes. Instead of worrying or agonizing about how many rate cuts we might get, if any, or what the shape of the yield curve will be in 6 months' time, have trades ready that will benefit from rising and falling rates. Stay well diversified and don't take too much directional risk. So, back to Get Shorty. And in the context of what I've said, this is not me saying, yes, we're going to have a real rates-driven correction. And as we know, tech leadership is back in charge, even after a few days of a bond market sell-off. And the leadership is narrowing again, and that's primarily because there's no sign of a cyclical recovery anywhere. Look at the Chinese bond market. Look at the data out of Europe, Germany, France, UK. Tentative signs of a slight improvement in the States. There isn't a sign, really, that the economies of the world are improving. And, of course, people keep hiding in tech. And so, of course, I'm going to focus on 2 tech names. These are the things I'm short at the moment against the longs. So the first name is CDW Corp, ticker CDW. So CDW provides hardware and software solutions and supports IT environments for companies, governments, education and healthcare organizations. And this business model is really one of an intermediary consultant, if you like. It interfaces between their client base, of which they've got 250,000, and the technology vendors. So it sells computer servers, networking equipment, and services such as systems integration, cloud services, lifestyle management. So if we have a look at the first chart, you can see the stock and the quants. It's cheap for a reason. They're going to report Q4 shortly, year-over-year declines in revenue and earnings, so not doing very well. Stock got a hit 20% after last earnings, and I still think there's plenty of downside. Looking at forward numbers, you've got mid-digit revenue growth and mid to high-digit earnings growth looking at 25 and 26, a whole load of average. Now, from the last earnings call, they said that they have reduced headcount to try and maintain margin, and they have walked away from low margin, less economic business. And that's good. Management is supposed to manage their platforms efficiently, but you can't, of course, cut your way to growth. Now, The other problem with that last statement is they obviously don't have any pricing power. A lot of their business is pretty generic, it's low margin. Hardware spending outside data centers is still really, really struggling. So in this world of exciting AI and technological change, I don't see any reason to own this company at all. Now, also in their earnings deck, they've said that they try and support growth with acquisition, and they've made 10 acquisitions in the last 5 years. And remember back to the revenue numbers, they're not moving the needle. So this is decidedly average, but it's this slide which should hopefully illustrate the true catalyst for the trade. You can see that the public sector makes up 40% of the total. And you can also see that the government's side of the business has started to see material declines. Now, when you think about the last administration and the deficit spending, obviously since COVID, hiring 40,000 people a month, spending wildly. Obviously, we don't get a recession when there's so much deficit spending flooding into the economy, but this stock has probably had the greatest tailwinds it's ever going to have. And that's before Elon Musk gets hold of the Department of Government Efficiency. So here's a stock that's average, doing badly, missing, cutting. Stock's performing badly, no real reason to own it, but the biggest catalyst is there'll be pressure on government budgets and across 40% of their business. And in this sort of market, any tech company that's going to miss again, cut again, will see a decent sell-off, could be another 20%. So they're coming out of all their tailwinds in a bad shape with headwinds to come. I think 150 is a reasonable price target. Analysts have been cutting. They've cut 11 times through into last earnings and out the other side. And I think there's a really good chance of an earnings miss. Structuring wise, I've gone for a March vertical. You could take it to February, but I want the extra time, another month for the new administration to come in and start aggressively talking about their plans. You can buy the March 170 puts for $4.50, sell the March 150s for $1.50. You can buy 16 of those spreads for $4,800, $3 a spread. The most they can make is the difference between the strikes, which is 17 to get to 20, and you'll make 567%. So they can just have a straight earnings miss. It's not really a rates trade. Obviously, higher rates won't help CDW. Now, the second idea, Palantir, is a bit more interesting. Obviously, those of you who follow the Flash will know that I've been extremely bullish on this. We've been talking about buying this sort of 18 months ago. Palantir and AppLovin have been my favorite software stocks for the last 18 months. Now, shorting a stock based on valuation or buying on valuation is the least attractive part of the whole trade proposition. You should never sell things just because they're expensive. You need reasons why. Now, remember, coming back to the full diversification, coming through Christmas, I wanted to have more rates protection, more trades that will do well if the bond market sells off. Now, post the election, the market got quite euphoric, pricing in all the potential good things of the Trump administration, conveniently forgetting the potential negatives, and there could be so many of those. Tariffs obviously being the obvious one. Inflation's going up through the last administration, and of course Trump's policies are considered generally inflationary. Now, when you have a look at this chart, just looking at the valuations, what's an extreme valuation? It's a nonsensical thing to say. Anything that's 30, 40, 50 times sales is just super highly rated, which means everyone believes the model is super scalable and we're going to get 30, 40% revenue and earnings growth for the next 3 or 4 or 5 years, which of course could happen. I am not saying I don't like Palantir. I love Palantir. And this is why it's unusual to sell a stock that I do like, but the valuations are extreme. And of course, timing's the difficulty. So you need a couple of extra catalysts, and obviously the bond market is a decent one. There's another catalyst potentially, and this again goes back to, most people think geopolitics is negative for the market. Well, look at the markets where they are now. Could geopolitics actually become a tailwind for the stock? Could there be some de-escalation over the next 6 months? Well, I don't know. As I said, I don't need a crystal ball. But if things do calm down a bit, even though the government will continue to spend and use Palantir, again, with extreme valuations, you only need a few things to slow down and the valuation can crunch quite a long way. Remember, what's my price target? Well, I'll tell you 50. And is that because 50 means it has to go up? No, of course not. 50, the stock is still expensive. Have a look at the numbers. They've got worse revenue growth and earnings growth and much higher valuations. So it's really adding diversification, seeing bond markets getting the stock going now, and having an arbitrary price target where it's still going to be expensive. And of course, Palantir is like a meme stock now, right? Everyone's long. It's going to be volatile. Now, with regard to structuring, generally, when I'm going to trade a high-vol name, if I'm buying it, I've got to wait for a sell-off. If I'm selling it, I need to sell the rally. And so AppLovin, when it was around 80, was when I got in. And I only mention this because when I said it's going to be a really volatile year, I think it could be quite choppy. It doesn't mean we're going to have a big melt up or we're going to have a recession and a one-way big sell-off. It could just be chopping around as everyone's super sensitive to relatively small changes in the rates market. So being late is always going to be bad. Now, the stock has fallen 13%. If I was going to trade it today, I've got two choices. I could do an April 60-50 vertical. You can see this trade. This will give you a return of only about 230%, which is on the low side. But that's the vertical after a high vol stock has moved 15-20% already. The second option is just to buy the April 60 puts. They're going to cost you $5.15. Buy 10 for your 5 grand position. And now I wait until the stock falls $10, and hopefully on the high vol name, I can then sell the 50s for around $5.15. That will get me into a free trade. Your credit is as big as the debit. You can't lose money, but your max will be $10. So there are the two get shorties, CDW and Palantir. Good trading, and I shall see you soon.